some horrific stories of how product got stuck in various points of entry. So the proposed remedy, training sessions in Pakistan, and authentic and updated website in India, which can be referred to, also an efficient dispute resolution mechanism. The fourth finding is mistrust, and this is important, monitoring of SME businesses by state and non-state actors on both sides of the border. Implication, SME live in fear of being branded as working for the enemy. The proposed remedy is confidence building measures required at the government level. It's like somebody said, nuts are on both sides of the border. Key findings on services is non-availability of services. Non-availability of services include direct courier services, cell phone roaming, bank branches, PIA only airline providing a direct flight. The implication of this is increases costs. People traveling to other countries use SIMs issued in third countries, especially UAE, Sri Lanka, UK. This creates uncertainty in the minds of the SMEs. And the proposed remedy is basic issues that can be resolved through administrative measures. Alternate routes. Option of exporting and importing through informal but highly efficient channels is very tempting. Implication of this is a very efficient shipping mechanism has developed. Carriers, KPR smugglers can deliver in less than 48 hours at any major destination in both India and Pakistan with zero risk to the shipper or the consignee. The way it operates is that they will pay the shipper in Pakistan for the product, and then they will take the money when they bring the product on the table of the Indian buyer. So there is no financial risk involved of both the shipper or of the consignee. Remedy is procedures and processes need to be simplified. Dispute resolution was issue number 7. SME trade association on both sides have been unable to resolve individual business disputes or influence government decisions to normalize trade. Implication is that in the absence of an institutional framework for the resolution of disputes involving SMEs, there is a reluctance to trade. And the remedy is trade bodies, associations representing the SME sector need to be involved by governments on both sides. On trade routes, limited land border crossings and limited number of products which can be imported from India using the Wagah-Atari border. Implication is that Karachi and Sindh-based SMEs unable to use more economical land routes for trading with counterparts in India. Punjab-based traders unable to realize full potential of land border due to limitations at existing borders in terms of logistics, capacity, products. Proposed remedy, open Khokra Par Munabhai land route to allow Karachi, Sindh-based traders to trade with their Indian counterparts. More land routes need to be opened in the Punjab. Perceived animosity, issue number 9, Pakistani traders report facing hostility once in India. The implication, hotels, taxi drivers, police and at times the general public make the Pakistani travelers feel unwelcome through their actions and words. The proposed remedy over here is that governments on both sides of the border need to play a role in emphasizing the benefits of trade through channels which reach the public at large, such as the media. And the final finding is, issue is trade is a hostage to other events such as unrest on LOC in Mumbai, even the elections in India. Implications are SMEs are reluctant to make long-term supply and sourcing commitments, including investment in each other's markets. A proposed remedy is that there should be an explicit agreement between the two governments that trade channels would remain open irrespective of other events. Thank you.
Thank you very much for keeping within time and being very clinical in pointing out not the animosity. Animosity is a rather bad word. Maybe difficulties, maybe diseases, and then giving remedies and answers to that.
The SMEs used over there.
Well, that's what I'm appealing to SMEs, that don't, if you can do away with such expressions, the better it is. But it's up to them. May I now request Dr. Elahi, eminently educated, a management graduate, a doctor with MSc in economics, and now teaching economics at the Center for Business and Economic Research, Institute of Business Administration, Karachi. Please.
Thank you. Thank you, Ikrar. Thank you, Nisha, for inviting me here in this conference. My talk is basically to discuss about the trade finance and the opportunities opportunities that are available in trade financing. And as we discussed since yesterday, that there is a lot of potential of trade in India and Pakistan, but it's not happening. So there must be some barriers that basically restrict that potential. And trade financing, like the lack of opportunities and the lack of facilities on trade financing is one of those barriers. So what I initially planned is like to go into the overview of trade financing, but now with the paucity of time, I would rather skip this part of like what are the like best practices in trade financing around the world. I would rather focus on what are the issues in trade financing between India and Pakistan, so that we can discuss more into that.
Yes.
So like this is like the initial slide that I prepared for like what basically the trade financing is all about. But the major risk that I want to cover in the trade financing, or the like all like in those risks include basically the transit risk. And this is because if we have this like lack of trust between the two counterparties, then it comes to this or it may translate into this transit risk, because nobody knows that what is going to happen. And there must be some like strict mechanism or a transparent system. Thereby we basically say, okay, these are the consignment that coming through this route, via this rail route or the road route or the sea route, and those like consignments need to be handled properly. So that basically reduces the transit risk in these two countries. Then because most of our trade is based on like US dollar. So though we are neighboring countries, and it would rather like make a more make a case for trade in domestic country, and I will come to that point later. But because we are doing this trade mostly in terms of US dollar, and like our local currencies with parity with the US dollar is very volatile. So that brings in the exchange risk, and because we are like the both countries have this depreciation of their rupees recently vis-a-vis US dollar, and that basically on one hand it facilitate exporters, but because the exporters are not that much demand across the border, and that basically I think Pradeep will tell us more about whether it is really happening because he is practically involved in that. So but it is like when I talk to different people there, and they find that this exchange risk is basically hurting this trade. And then we have this political and country risk. This is, I think, dominates all things, and including this trade financing, because of this lack of sometimes implementation of the agreed MOUs and agreements on. There are several things that we move, like yesterday Dr. Ashar mentioned that we used to like take 2 steps forward, 1 step backward, or sometimes 1 step forward even, and 2 steps backward, and we're still like on the same. So those things which we basically agreed upon back in 2006 of opening bank branches across the border, it is not yet happening. So this is something that is very much related to this like regime specific, or basically the country specific political and risk. So that also basically hinders this trade financing opportunities. Then we have this economic risk. This is mostly from the Pakistan's perspective, because from India it's something like it's booming. It has a good decade just across, and now like, but in case of Pakistan, recently in the last like since 2008-9, we did not have a good like economy going, and that is why basically sometimes it also like it affects everything, including the trade, and that basically also becomes one of these risk involved. And then we have this environmental and the counterparties risk, and that includes basically when we have this, for example, trade across countries, and then if it's not very much in line with the standards, and then basically we have these types of risks. So these are the major risks that one need to consider. Now we have several products whereby we basically finance trade, and the one that is mostly used in Indo-Pak trade is this cash in advance, or the advance payment, because of this sort of lack of trust, and like we are not giving like a lot of basically facilities to across the world. I think the most convenient and the most secure way of doing trade is basically the advance payment. And this advance payment basically secure exporters because they already received this payment, but it basically hinders the potential of trade, and that is why we have this, like if we want to grow this trade, then we need to go beyond this advance payment regime to finance trades. Other things that exist is basically the letter of credit is still using, but not to the full extent because of difficulties in its operations. I would rather like mention it explicitly that there is no difference in terms of like policies, that when you go and see the papers, like so there is no discrimination on either side of the border, neither on this Pakistani side nor on the Indian side, about any discrimination that okay, we'll treat the LCs from India or Pakistan this way and rest of the world the other way. It's similar, but as far as like I think Waqar just mentioned yesterday that the policies are same, but how these policies are implemented, there is a difference. So if, for example, we have certain risks involved in LCs opening and this, so we maybe overlook those risks in terms of like trade financing for other regions, but if it's coming to this Pakistan-India trade, will rather more specific on following these guidelines more diligently in terms of checking whether to honor these LCs or not. So this makes the financing of trades across the borders rather more difficult. Similarly, and like as far as I like get responses from the different stakeholders, that as far as cost is concerned, so there is not much of a difference. The cost of financing or the cost of having these financial instruments is it's not an issue for those importers and exporters. It is just basically the mindset or the facilitations from the both sides of the border that they want to have. That basically creates major hurdle for financing of trade across the border. So it's not the cost. It is not something the cost is so exorbitant that they are not basically willing to use those formal financing techniques. And then we have like other things possible is basically the bank drafts. But because though we initially agreed that we should have like 2 Pakistani banks opening in India and 2 Indian banks opening in Pakistan, when I talked to the people in the Central Bank of Pakistan, they mentioned that we already giving NOCs to the Indian banks to operate in Pakistan, but we did not get like the reciprocity from the Reserve Bank of India on that count. So they basically mentioned that because it's not happening, and those are the things that basically restrict or that is why the bank branch is not operating. So in this case, they need to rely on some other banks, and then they're like having this bank drafts is not not so not so operational in the case of Pakistan-India trade. Like ideally what we could have is an open account facility whereby we just like start doing trade on credit, and then eventually it is on cyclical basis. It's going to be the payments are going to be made on periodic basis. But this is something that can only be operationalized if we have this like lack of trust removed, and we have trust on either side, and then basically, and this is the most preferred and least transactional cost on through this system. So if we really want to basically spur growth statistics across the border, then we should come up to this particular mode of financing where we have this facility to our exporters and importers to have an open account with the counterparties in across the border, and they basically do business just like they do in domestic trading. So these are the documents that typically used, and within this, especially this consular invoices and insurance certificate, they like what feedback I got, that they basically are more difficult to have in time, and basically they have more operational issues in these 2 documents, and sometimes also the sanctity of commercial invoices is also somehow suboptimal, and they say that okay, sometimes they are accurate, other times may not. So these are the things that we really need to come up specifically, that these are the things that we need to address, and if we really want these formal financing channels to basically promote India-Pakistan trade. Now the techniques are already there, we just need to have this. Now coming to this key challenges in terms of India-Pakistan trade. Okay, so arranging financing is like domestically it's not the issue, but if it's like cross-border, then we have this key. So we really need to make a proper blueprint or proper like scheme that these are the channels available to arrange financing. So this is a key channel, and then the regulation across the border. It sometimes there is a like change in the policy and which is not being informed properly to the counterparties across the border, and that is why they are not able to get benefited from that change in regime. So we need to basically have this system whereby the parties across the border, they basically check what are the current regulations about the financing so that they avail if there is any opportunities in there. Okay, and then how to manage this counterparty risk. This is again important because lack of as mentioned by Samir, that lack of visas available. So that is why there's like the mutual people to people and business to business contact between the two nations is very limited, and that basically creates this counterparty risk. So we need to basically also we need to control and optimize the cash, and reducing the days sales remains outstanding and days payments outstanding. These are the two critical number that every firm want to basically minimize, so that their cash flow is going to be like most efficiently used. But here we need to see that how this trade financing is going to help in those things. And then the expertise of the local market. This is something that basically these particular sectoral specific studies, they did a great job in assessing these expertise. Now what I do is like now as I just mentioned, that the major issues is basically the rigidities and the LC confirmation and delays, not the cost, but basically the operation. So if we somehow make improvement in terms of operations of these trade financing, then we have a lot of opportunities in there. And also we had this Asian clearing unit. The very purpose of having this unit is basically to facilitate the regional trade. But somehow when I talk to the stakeholders, they say instead of facilitating trade, they somehow make an additional bureaucratic layer to basically have this. Now it takes like 5 to 7 days of trade basically settlements between India and Pakistan, and as Pradeep mentioned in the presentation in Karachi, that if you have this 5 to 7 days in the payments mechanism, then it basically kills the proximity advantage, because your trades like going across border in just like 2 hours, and your payment takes like 5 to 7 days to manage, and then you lose all those like advantages in doing that. And then there are other issues related to branch opening, as I already mentioned, and information asymmetries and things. So, and SMEs, because they are basically the main stakeholders, and they are the main sector of the economy that are dealing with Indo-Pakistan trade, and their concern is about like sometimes the banks don't find that they are profitable enough to finance their basically, because